IVM.
I find it baffling how I've lived my life without CRED up till now because now I can never go back. With CRED Protect, you will never miss a due date again because the app reminds you to pay your bills on time. Plus, it detects any hidden charges on your bill and gives you category-based analysis of your spends. It's like they've thought of everything to help make management of my cards frictionless. Don't believe me? Well, just download the CRED app. Folks, welcome to Paisa Vaisa presented by CRED, the most rewarding credit card bill payments app and powered by Quartr. I'm your host Anupam Gupta, B50 on Twitter. And guys, I am super duper excited and thrilled to have our guest today, really, because it's not often that we get a veteran investor on our show. I'd say that this is actually the first time. It's my honor to welcome Hiren Ved, co-founder, CEO, director, and CIO at Alchemy Capital Management. Oh boy, we're going to talk about a lot of stuff on this episode. So stay tuned, folks. We'll be right back after this short convenience break.
Do check out our show, Tech Life at Intuit, hosted by Shiladitya Mukhopadhyay. Shiladitya talks to Gayatri Belapurkar, Director, Product Development, and Sivaramam Satyamurthy, Principal Software Engineer at Intuit India. Here's what they have to say about Intuit's transformation from a monolithic system of tech architecture to a more modern era of microservices. Catch episodes of Tech Life at Intuit on the IVM Podcast app, website, or wherever you get your podcast from.
Hiren, welcome to Paisa Vaisa. Thank you so much for doing this for our listeners.
Well, thank you so much, Anupam, and it's a pleasure to be here. Hope to have an interesting conversation with you.
Sure, I hope so too. Let's start here. And, I don't want to just jump into the whole kya lagta hai thing because I'm so excited to have Alchemy here. It's a brand that not many people know, and especially not today's generation that has come in this last 1 year through various apps. So just, let's just start with how Alchemy became among the oldest and largest, obviously much respected PMSs in India. Quick recap for our listeners on how Alchemy was built and what it offers today.
Sure. So we actually have a very interesting story, pretty much akin to many of the startup stories that you hear nowadays. I came to the stock market very early. I mean, our family has had a history of investing in the capital markets for almost 40, 50 years, starting from my grandfather. So I was very clear that post my studies, the stock market is a place where I want to be. I was pretty young. My dad used to take me to these annual shareholder meetings. Well, now all of them happen virtually, but back then it was, you go to a big hall and, you sit there and you listen into the chairman and the company managements talking about the future of their businesses. And that intrigued me significantly at a very young age. It had a profound impact on me. And I was very clear that this is my calling. So immediately after my, studies, I went headlong. And in those days, and I'm talking about the early 90s, very few professionals would get into the equity markets, right? It was still the domain of the dhotiwalas and the capwalas, as they say, which dominated the who were brokers. Mostly investments used to happen on tips. What the broker would recommend you. There was very little research that was done. So I started my career. I had the opportunity of working with two firms for the first 9 years of my career, in equity research. And it gave me a grounding on how to study companies. And, very early, I would visit the facilities of a company, go and visit the plant, see how the manufacturing process works, and so on and so forth. And during these visits, I came in touch with two other young, boys of my age. I was just 21, 22, Lashit and Ashwin. And we became friends. And we stayed friends, for between 91 and 99. We used to compare notes. We used to talk about the markets. And then after 9 years of working with two organizations, I decided that I wanted to be an entrepreneur. And when you take these career defining decisions, what do? You sit with some of your best buddies in the evening over a drink, and you break the news to them and say, you know what, I think I'm done working for other people. I want to start my own portfolio management company. I think there is a need in the market because people don't understand investments, they don't understand research, but they want to invest. I think there is a need where professionals need to get into this and deliver research-based portfolio management services. And then one thing led to the other, and all of us friends, which included Lashit Ashwin, my current co-founders and partners, and also a gentleman who everybody knows in the equity markets, a person, Rakesh Junjunwala, who's the big bull, as they call it. He was also a co-founder in Alchemy. And we all decided that it was time that we set up a portfolio management company to provide professional services. So we all got together. We set up Alchemy Capital way back in 99, 2000. We applied to SEBI for a license, and we got one in 2001. And then we started business in 2002, very modest, with a few friends and acquaintances, giving us about 7 crores and 5 clients. And from there, we are now, obviously, we manage thousands of clients and almost over $1 billion in assets.
Wow, that's fantastic. And honestly, that's such a great story. Just about 20 years old, reached $1 billion, and you've seen so much. And that's what I want to ask you next. How has the market evolved for HNIs and PMS clients, right? Because that's what you're focusing in. When I look back in 99, 2000, 2001, it was non-existent. You didn't have professional wealth managers at that point of time. To today, when I think the PMS industry would probably be in the billions of dollars in India and more coming up, and there are family offices and there are professional wealth managers. Just a quick recap or a journey of how this has been for you so far. Now, how's it changed for your clients, of course?
So I think it's been an interesting story so far. I think in the initial stages, it took time because, people were pretty much investing by themselves, as I said, by tips and, there were obviously a few people who were quite knowledgeable, and they would read up on their companies and invest. But I think when we started, we brought a certain discipline to the entire process. And I think that essentially back then and now, the difference that I see is that even our customers are now very, very well evolved. And a lot of that has to do with the availability of information. Back then, access to information was very difficult, right? So, today companies give quarterly results. They have analyst calls. They have presentations that they have to put on their website. There are so many resources, online resources that people can refer to, and information travels fast, right? I think back then, one edge that we had was having access to financial information and understanding of what companies are doing and their future plans ahead of what the normal investor would have. And that itself was an edge. Obviously, the second edge was how you analyze that information and then create long-term investment portfolios. I think today, in many senses, I compete with my customer. Sometimes, I'm amazed that my clients today know more sometimes. At least in terms of access to information, is almost equal. That's no longer an edge anymore. I think the edge has moved from access to how you draw insights into various businesses, right? So I think in many senses, with COVID last year, we kind of turned full circle, which is that people went from investing by themselves to then giving money to portfolio managers and investing in mutual funds and wealth and giving money to wealth managers. And now we are seeing a trend back of people wanting to invest all by themselves again, because you have online platforms which make it very easy for people to do transactions. And therefore, we are at, in some senses, a very seminal disruptive point in our industry where we need to justify what edge do we have as against our investors who are today equally savvy, well read, and have access to information. And I think that is what the industry now has to, if it has to grow, and I think it will grow from here. I think that we are seeing the birth of a whole new millennial investors, do-it-yourself investors, right? So for me, for us, I think our typical target client was somebody who is in his late 40s, maybe 50s, who has made it in life. He's already earned his wealth. He's made a lot of money. Now he wants to invest that money. He's probably done with buying his house and car and so on and so forth, and then wants to invest his money. So what we call as old wealth, right? Now, as I see the landscape going forward from here, we continue to have the old wealth, but I think we have two new sets of investors. One are people who are just beginning to earn money and are saving and are understanding that, it makes a lot of sense to invest in equities as an asset class as opposed to putting money in a bank or, buying bonds or so on and so forth. And then you mentioned about the family offices. So, with the kind of dynamism that we are seeing in the new economy, so many entrepreneurs are going IPO. Or people are selling out their businesses or they are going public, and they have this huge amount of money that they now have with them after going public. And this is what I call as the new money or the new age savvy investors who are looking for, a professional to invest, for us to access opportunities across a broad spectrum. So I think from a demographic point of view, we have now a much younger, much more savvy, and a much younger entrepreneurs who are unlocking value in their businesses at a much early age than what they used to do many years ago.
Very interesting. Before we, end this first part of this episode here, and tell us about the future, and from two angles. One, I think you already touched on in your previous reply. How is regulation going to change PMS? Right? We started with, first, of course, this was unregulated, then regulated, then 25 lakhs, now 50 lakhs. Now you've got a concept of accredited investors that SEBI has just introduced. And
Right.
if you just overlay technology on this, people are saying that you can now have a much more refined product, or you can understand markets better, or I don't know. So what's your view? Regulation, technology going forward for PMSs?
So I think if you look at, Anupam, the asset management industry globally, right? I think let's first come to technology and then I'll come to regulation. I think what technology has done is it has democratized, like everything else, it has democratized investing as well, right? So today, you can have a product and you need not necessarily have a great physical interface. You don't need to physically go and meet a relationship manager or a portfolio manager and then decide, right? I mean, you have the information online, you look up everything, you look at the philosophy of the product, you look at the strategy, you look at the past performance, and then you decide whether you want to buy or not. And today you could, there are several innovations that technology will enable. For example, many of the online platforms are now saying, okay, I'm going to make a basket of recovery stocks. Let's say we are all recovering from COVID, right? So, sectors that were substantially impacted. So can I create a basket of securities which will do, these are businesses which will do well as we open up the economy, the opening up trade, as they say, right? And there is a basket available. It's so easy. At a press of a button, you buy. Maybe somebody has created a basket of hotels and cinema theaters and, those kind of QSRs and kind of businesses which you can buy, because people can now take calls saying that, hey, I think, these businesses and these stocks will do very well. So technology has made access very easy, not just to people in towns. So typically, if you look at the demographics earlier, most of the investors were either from the big metros like Mumbai, Delhi, Ahmedabad, Bangalore, Calcutta. Today, your investor can be from anywhere. It can be from, town B, town C, from a very small town, and he has access to products. So I think access, democratization, and much more innovation at the product level. In terms of regulations, I think regulations have also kept pace. You had a minimum ticket size because people thought that this is a sophisticated product. There was a lot of mis-selling which used to happen in the process because, your traditional distributors were interested in earning fees, distribution fees. So typically in India, the evolution has been that most financial products have been push products, right? So you have an advisor or a relationship manager who says, "Arey saab, you buy this, ye bahut acha hai, ye Alchemy ka PMS hai, ye kisi, ASK ka PMS hai, jo bhi hai." And there was a lot of push, like it used to happen even in insurance products or any other investment product. I think what the regulations are trying to do by putting limits to ticket sizes was that to kind of put a gate and say that, okay, probably an investor who can cut a check of 50 lakhs or invest 50 lakhs in a product has a reasonable net worth and understands the product and understands the financial markets, and therefore there is to be a minimum cutoff of 50 lakhs or 25 lakhs, right? And then the idea was that the regulator wanted to push the first time retail investors more towards the mutual funds. And the idea was that the more savvy, the more evolved investor would come to PMSs and AIFs, right? I think now the regulator has gone one step forward recently with this whole issue of accredited investors, right? Where you have to demonstrate that you have a certain net worth, you have certain amount of money in financial assets, and therefore, you can sell more and more sophisticated products. Like, for example, if you're an accredited investor, I can now probably, even in a PMS format, invest in unlisted securities for them, which was not possible earlier. My domain was only the listed securities. That changed when the AIFs came, where the minimum ticket size was 1 crore. And now I think the regulator is saying, hey, you know what? That was the old way of restricting investors. What if I'm savvy? What if I'm an accredited investor, but I want to invest only 25 lakhs in an AIF? Why shouldn't I be allowed to do that? Why should the minimum amount be only 1 crore? And hence, the whole concept of an accredited investor has come into being, right? So I think regulations are moving earlier, in my opinion, the regulations were purely protect the investor. Let's see that he's not being missold any product. Let's see that he understands the product that he's buying. Now, I think as the economy matures, as the capital markets matures, and as there is more democratization, I think the whole concept of accredited investors would mean that sophisticated investors will have access to even more sophisticated and risky products, so to speak. So tomorrow I could have an AIF or a PMS product purely focused on saying that, hey, I can invest in unlisted. And today there's a lot of interest, as you might know, with the successful IPO of Zomato, and this is just the beginning, where individual investors want to participate in the new economy. They think that they want to participate in the new economy. They've seen how wealth has been created by the global tech giants like the Googles and the Alphabets and the Apples and the Netflixes of the world. And they now want to play these new economy business models in India. So I think this concept of accredited investors will help more sophisticated investors to access what was not in their domain earlier. And I think that's a big change that is beginning to happen. And I think the time will come where companies will be able to access money from, directly. They may not necessarily have to go to a venture capitalist or a private equity investor. Maybe they go there for the early rounds, and for the subsequent rounds, they might come just to the broad markets, to the pre-IPO market before they hit IPO. So I think that's one level of change in the future that I see. The second change that we see, and what we at Alchemy are also innovating, I think investment products are likely to evolve around three pivots. One is active investors like myself, people who are very experienced and have years of experience in cycles, managing and creating portfolios for clients. Secondly, we are seeing the birth of quantitative strategies or data-driven strategies or algorithm-based strategies, right? So this is bringing math and computing power to the world of investing. And for example, in Alchemy, over the last 5-7 years, we almost had like an Alchemy lab where we created a very unique strategy called Alchemy Ascent, which today creates portfolios based on a fundamental based algorithm, right? So there is, in a sense, no portfolio manager, so to speak, but there is a set of computer programs. Obviously, what logic you built in that program is very important, who then start building portfolios. And we are seeing that there is tremendous interest from investors in something like this, because this takes away the risk of the so-called individualized star portfolio manager concept, right? That's the second pivot. And the third pivot is ETFs, a low-cost way of just replicating the index and investing. You don't have to worry. You don't need to find the best portfolio manager. You don't need to do all that research about who's good, who's bad, whose track record is good. You just go and buy the Nifty ETF or a Sensex ETF or some other mid-cap ETFs, and there will be many ETFs which will come into play, which is a low-cost way of replicating an index and just investing in the index. So I think the investment world is going to get very interesting. It's going to pivot around these three: active managers, ETFs, and quantitative strategies.
Fantastic. That's very interesting. Hiren, before we go into break, I have to ask you, that's a lovely painting that you got behind you. Folks, if you're not watching this, and actually you could just go and check out YouTube, because we have a clip of this entire episode out there, but I have to ask you, what is the painting? I can see a bull for sure. Is that a bear or something else?
No, there are two bulls. So this is a famous artist called Partho Datta. He's famous for his charcoal paintings, and for example, the bull is a very, very iconic animal in the investment world. So it's in fact, if you come to our office, we have a lot of paintings, a lot of bulls around, and this one tells you that we are always bullish on the long-term prospects of India and equities. So the two bulls behind me.
Fantastic. And what is the Alchemy office still in South Mumbai, or have you guys also shifted to BKC?
No, we are still in what is called as in Colaba. It's a beautiful area. It's a lovely office. It's a 100-year-old building. It's a heritage property, and very high ceilings. So no, we haven't moved to Lower Parel and BKC. We still we started where the old money was, right? And now it really doesn't matter where the new money is, because I can get onto a Zoom call and talk to a potential investor in Mysore or Bangalore or Ludhiana or wherever, and do my business, right? So, but we have debated many times, should we shift to BKC? But this is such a beautiful building. If somebody ever comes, or if you have an opportunity to walk into I mean, people get amazed. I think 50% of my selling does when a client enters my office.
This is if I remember it correctly from what this is Amarchand Mansion, right?
Perfectly, yes. This is Amarchand Mansion. It's a beautiful, a lot of history to this building. Yes.
The BSE would be a couple of kilometers away from where you are, and the BSE itself is maybe 100 or 500 meters away from where the original market used to be back in the 19th century in 1865, when you had that old banyan tree. And you're right about the history, man. I can go on and on.
Yeah, this. I mean, So that's at it's about 2 kilometers from where we are. We are at the more quieter part of town, and anyway, I think the town has become much more quieter now. This has become, we are opposite the university, and from our building, when visitors come, I tell them that you can see all the temples of democracy. There is the High Court. I can see the RBI building. I can see the Bombay Stock Exchange. And I can see the Jahangir Art Museum, right? So culture, finance, law, it's amazing to be. I mean, it's quite a bit of travel for me, but we just don't feel like giving up this office.
I hear you loud and clear, man. If things were better, I could have just taken the IVM crew and landed up at your place for a recording. But you can just go on this. But on that note, folks, let's take a CRED convenience break. Don't go anywhere. When I come back, we are talking equities and Hiren's view on what lies ahead. My guest, Hiren Ved, co-founder, CEO, director, and CIO, Alchemy Capital Management.
$100. That's all it takes to begin your journey with Bitcoin and Ethereum. No, really. With CoinSwitch, you can start investing in over 100 cryptocurrencies with just 100 rupees. On top of that, there are zero charges for deposits and withdrawals, so you can trade, buy, sell, however and whenever you want. All of this, plus their extremely intuitive interface, makes CoinSwitch the perfect app for beginners in the crypto space. But don't take my word for it. Just download CoinSwitch for free and try it out for yourself. If you'd like more information on cryptocurrencies, tune into a show about crypto with me, Rohan Joshi, my new adventure on IVM Podcasts. CoinSwitch, kuch to badlega.
Folks, we have a listener's question.
Hello, Anupam. I miss listening to the conference call of a company that I track. Where can I listen to the recording?
Okay, that happens to a lot of us, because come on, quarterly results happen 4 times in a year and they get bunched up together, and there's a very good chance that you will miss out on listening to one conference call or 2 conference calls. And where do you go for that, right? I mean, you want to listen to the entire playback of the conference call, and probably you want the transcript also of the conference call. Well, there you go. You've got the Quartr app. That's Quartr. And on the Quartr app, you can create a list of your favorite companies, and wherever the company releases, right, the transcript and the recording of the conference call, the Quartr app will have that. Just open the app, check out your company, and it will show there, right? Q1, Q2, Q3, Q4. And you can listen to the entire recording of the conference call, of course, with pause, rewind, stuff like that. And wherever it's available, you'll even get the transcript of the conference call. So, folks, that is a Quartr app, Quartr. And welcome back, folks. Let's get into it. Now, I want to start with a very broad view on equities. Right now, there is this bunch of people on the street who believe that we are where we were in 2003, and this is the start of a long bull cycle. Let's just get into it. Your view, is this really the long-term construct for investing in Indian equities?
Well, the short answer is yes. I mean, there are a couple of differences between 2003, and there are a couple of similarities between now and 2003, right? The similarities are that we are, I believe India is starting a new economic growth cycle, which usually follows some sort of a great crisis. The crisis resets several things, and in many ways, usually in India, as they always say, that crisis brings reforms. Okay, so when there is adversity at the macro level, and this time the adversity was brought by a health issue, COVID, right? So A lot of businesses got disrupted. Economic activity got massively disrupted last year. And people can only remember 2008-9. Before that, it was the tech bust. I have seen several cycles. 91 is when I entered the markets. We had the Harshad Mehta boom. Then we had a crash. And then it took several years for the economy to get back on track. And there were a burst of reforms that happened in 1991. But back then, economic cycles were longer. It took longer to recover from a crisis, whether an economic crisis or a capital markets crisis, right? 2000 was another seminal moment where markets went into a complete frenzy because of the dot-com and the telecom boom. Subsequent to that, we had a crisis. But presaging that, we had the Asian economic crisis, and a lot of manufacturing companies went into a complete dizzy. And then we had a new cycle which started in 2003, which culminated in the boom up to 2008-9. Now, where we are today, I think that the reason why I believe we are in a new economic cycle is there are a few things which are powering this. One is that COVID was a big shock to companies and the economy. And when you get a big shock, it's a big reset moment, right? And people are very amused. A lot of my friends who are not in the stock market say, "Arey, tere ko kya hai? Your market, your index is at 16,000, but look at what is happening on the ground. Many small businesses got impacted, traders, or, if you were in the hospitality industry, or if you owned a restaurant, or, you were running an SME, obviously things have been very, very tough." And what happened, I think, last year was that it forced every company, every business to rethink the business. Businesses became more agile. They had to cut costs. They had to refocus, and they had to become digitally agile and active. So there is a huge productivity cycle which is setting in. The US boomed in the 60s and the 70s after the US built massive road infrastructure, and then there was the boom in the 70s and 80s in the US. I think why India will boom is because what we have done is that we have built digital highways with Aadhaar, with UPI. We have built what I call a soft infrastructure, right? Connecting digitally Aadhaar to bank accounts. And today, with the kind of innovation that we are seeing in every single sector of the industry, right? I'll give you an example. A friend of mine during COVID started a food business. She was making she started making sushis. Now, this was only possible in this day and age because of technology, because she started advertising herself on Instagram, and you had VFast couriers who could then deliver the sushis to the customers, and the payments were made on Google Pay, right? Now, just imagine somebody becoming an entrepreneur without setting up an elaborate infrastructure and office, because the enabling infrastructure to do a business has become so much easy. You can promote yourself on Instagram or any of the social media, Facebook, whatever. Today, you have a supply chain infrastructure which has been put in place, who can pick up things from one end of the town and send it, or one end of the country and send it to another end of the country. And there is digital payments, which can affect a transaction. Now, this is something which is phenomenal, right? And we are likely to see a massive growth cycle powered by digital infrastructure and highways. And people will not realize it now, but they will realize it over a period of time, what this will do to our productivity and profits. And I think what actually happened was that the top 200 companies in our country adapted very nicely to this crisis. They cut costs, they became digitally savvy, and obviously there was consolidation across sectors. So though the cake shrunk, the more agile companies were able to get larger and larger market share of the cake. And what you see as the Sensex or the Nifty at 16,000 and 54,000 is basically not a reflection of the overall economy, but the fact that your top companies have come out of this crisis financially much stronger, cash flows much stronger. And I think this is just the beginning. I don't want to bore your listeners with too much of data, but I think one piece of data is very important. Whenever there is a crisis, usually we bottom out. You know, if you add up all the profits of all the corporates that are in this country, largely listed, and then divided by the GDP, it gives you a ratio of corporate profits to GDP. We peaked at 7.5% in 2008. From there, we bottomed out to 1.6, 1.7% in 2019 and 2020. And in 2021, when nobody would have expected the corporate sector to deliver much better profits, that ratio has gone up to 2.6. And my feeling is that we are headed back to the 5-7% of GDP, which means that corporate profits, in my opinion, are likely to compound between 25 to 30% for the next 3 to 5 years. And that is what is likely to drive markets. So I'm very bullish on the economy and the markets. And this is going to be driven by not only the old manufacturing giants and companies which have consolidated, but also will be driven by the new tech entrepreneurs and the whole digital ecosystem that India has built.
Fantastic. No one can get bored with data here. Anyone who loves the market intrinsically, I mean, come on, you've grown up on annual reports, right? I mean, that's the basic starting point of any investment. So please get the data on to us. We would love to hear any insightful data that you've got. And in fact, related to that itself is my next question, because see, now a lot of people, when they plug in equities into their longer term financial goals, because now financial planning has become a thing, having goals has become a thing. It's not like it used to be back in the late 90s where you used to just invest in stocks and that's it. You used to keep on investing. There'd be a boom, there'd be a bust, you'd see your net worth. And now equities form a part of a portfolio. People's financial goals depend on that. And as part of that, in any Excel file that has financial planning, you plug in and just call it a rate of return, sustainable rate of return, much like how people do their DCF. So in your view, right, what do you think is a reasonable, sustainable rate of return, even a broad range that you think equities in India can deliver going forward? You spoke about a 25-30% profit CAGR, right, over the next decade. Logically, profit growth should be equal to equity growth, but your views?
Yeah, so, I can't say for a decade, but I can certainly say for the next 3 to 4 years, because profitability, aggregate profitability is also cyclical in many senses, right? But the math about what equities what kind of returns investors should expect. And, just hopping back to the previous question, one difference between 2003 and today is that while we are starting a new economic growth cycle and a new profit cycle, valuations in 2003 were much more attractive and the markets were far more cheaper. That's not the case where we are today. Because as I said, this time information and the kind of stimulus the global central banks and the kind of liquidity that they have put in has meant that the pullback has been very, very sharp. But having said that, I think the math is very simple. The way I look at it is that if you take the long-term returns of the Sensex or the Nifty, they typically tend to compound at 2 to 3% more than nominal GDP. So let's say your real GDP grows at, let's assume over the next few years, our real India grows at 6 to 7%. My personal feeling is that we could go back to 7-8% growth, but for the time being, let's be conservative and say 6 to 7% real GDP growth. you add 5 or 6% inflation, you land up at 12% nominal GDP growth. Now, GDP is a function of efficient and inefficient companies, right? I'm assuming that the market, the Nifty or the Sensex is always efficient because it throws out companies which don't do well. It's a self-cleaning mechanism and it takes the winners in the Nifty, right? They typically tend to compound 2 to 3% more than nominal GDP because corporate profits tend to compound at 2 to 3% more than nominal GDP. So if nominal GDP is going to compound at 12 and you add 3%, that's 15%. I think markets could compound at 15% for the next many, many years in India. But we all know that it's not a steady 1.15 into 1.15 into 1.15, right? I mean, it is very non-linear, but if you average it out over a long period of time, that's the kind of compounding. Now, as savvy investors or as savvy money managers, how much alpha can you add on top of that 15% is what you will end up. So, for example, over the last 19 odd years that we've been in the markets, we've been able to add about 5 percentage point alpha over the index over the last 19 years. So if the index has compounded at 15 or 14, we've been able to deliver 19 or 20% over 20 years.
Over right? 20 years, yeah. So that on a CAGR basis, even after fees, you're talking significant wealth generation.
Exactly. So if we now go back to the new math, which is 12% nominal GDP growth, profit growth at 15%, Nifty compounding at 15%, I think maybe 5%, because the markets are becoming more efficient, beating the market by 5%, maybe a stretch target. But if you can beat the market by between 3 to 5%, let's say, I think if somebody can compound money at 17, 18%, given where interest rates are, I think you should be happy as an investor. The other very simple rule of thumb that I use, if you don't want to get into all of this calculation, is that usually the Nifty compounds at 2x a 10-year government bond yield. If you put money in a safe 10-year government bond, if it gives you 6%, just double that. That's what the Nifty should give you, right? So at a bare minimum. But I think because we are starting a new productivity cycle in this country, led by technology, led by more innovation and efficiency, I think next 2-3 years, my sense is that the next 3 to 5 years, I think the markets can compound at a slightly better rate than what it has done historically.
And amazing. I wish I could, have a separate episode with you just on this topic, because there's so much to talk about this. You could talk about active versus passive. You could talk about how, there could be room on upside, on outside, etc. But as usual, time is a constraint. Let's wrap up with some specifics here, Hiren. As vaccination picks up, hopefully it does. We've kind of reached some kind of stagnation point out here. Maybe we reach the December target, maybe we don't. But it looks like, maybe by next year we'll be in a better place as compared to where we are now. In your view, what are the sectors that will recover from this pandemic blow?
So I think, I think that I would kind of put it into 3 broad categories. One is that I think the exporters are likely to do phenomenally well. I think exports will get a very big leg up. Largely, if you look at the tech services industry in India or the IT services industry, because of the whole digital wave that we are seeing, if every business around the globe is going to put their data and applications on the cloud and use AI and ML and e-commerce, then obviously they will have to spend on technology over the next couple of years. So I think IT services, where India has a clear global competitive edge, will do well. There are other areas where India has a globally competitive edge, which is in pharmaceuticals, in API manufacturing, in specialty chemicals, in auto components. These are traditional areas where Indian companies have done phenomenally well. So I think one is the export basket, or I would say sectors where Indian companies have been able to demonstrate a globally competitive edge. So that's one basket. The second, I think, is all sectors which got significantly impacted because of the COVID crisis. So all your consumer discretionary sectors or recreation sectors, like, hotels, tourism, restaurants, automotive, right? Because people were not going out, they were, in their houses, they could not spend money on these activities. Obviously they did a lot that they could sitting at home, ordering on e-commerce. But I mean, Homo sapiens are not meant to be in you can't bottle them up in 1,000 square feet space forever, right? People have the urge to go out and explore the world, to socially meet. So I think all the industries which got impacted, whether it was retailing, whether it was cinema halls, whether it was travel, tourism, all those will do phenomenally well, in my opinion. And the last bucket is what I call as the new age digitally powered business models, e-commerce, right? And there is a lot of hype around that right now. But that's how usually a trend starts. There is a lot of hype, there's a lot of excitement. And I think many of these new age companies which are likely to go IPO, some of them will truly become giants and will become big and create a lot of value. I think the key from here on would be to have the ability to understand and evaluate which of these are likely to be winners, but clearly not all of them are likely to be winners, right? I think that's the more interesting phase that I see going forward. So that's how I would put the future investing opportunity landscape.
It's good to talk to an old school investor who believes in this future, because a lot of our public market guys who go back to the 90s and all that can't, you hear statements in the press about how can you have valuation without profits? I mean, that kind of hits a mental hurdle for all of us who are used to PEs and EV EBITDAs and price to sales and DCF models. How do you value all of this? But I like the fact that, you please go on. Yeah.
No, I think the key to being, one of the things that I've learned as an investor is that, do not have any ideological cobwebs or mindsets or limitations, right? I'm not saying, I truly believe that cash flows and profitable and profits are very important for any organization to create lasting value, right? And I'm using sustainable lasting value. I think, however, this whole model of venture capital, private equity funded startups, is that these investors who are betting on these companies are telling the entrepreneurs, look, in the good old days, you took 10, 20, 30 years to build a profitable business of scale. बोलते थे एक generation निकल जाता है to build something, right? The new investors are telling the entrepreneurs, look, can you do the same thing in 10 years? Can you achieve scale with speed? And don't worry about near-term profitability. If you can achieve scale and speed in a very short period of time, I will keep funding you no matter you have losses today. Now that's a very different model than what it used to be. In the early times, you started small, you made a little bit of profits, you took some loans, then you again expanded, then you again became profits, and it took you 10, 20, 30 years to build a sustainable business. You are now trying to short circuit that process with two things. One is that because of technology, you are able to access your customers quicker. And because of risk capital, you are able to fund your business at a much bigger scale without waiting for current profitability. That doesn't mean that future profitability and cash flows are not important, right? So it's like instead of the dog wagging the tail, it's the tail wagging the dog. And that is something that people are not able to understand. कि ये कैसे हो सकता है, right? And this was similar the case. I remember when the IT services boom happened in the 90s, people couldn't understand, ye Infosys karta kya hai? Matlab, what is the product, right? And they could not understand this hyper growth. They kept on growing at 40, 50%. Obviously, they were making money. That was the big difference, right? But they couldn't understand during their hyper growth phase, IT service companies used to trade at 50, 60, 70, 100 Ps. And people the traditional investors just couldn't understand ki ye kaise ho sakta hai, right? But it happened. And similarly, it is likely to happen. It's a new wave, right? But as I said, one will have to take a bet and keep evaluating these businesses and say, ठीक है, आप next 3 साल पैसा नहीं बनाओगे. But in the 4th year or the 5th year or the 6th year, at some point in time, you have to make money. Even the best of the tech companies in the world today, if you look at them, they make huge amount of cash flows. Look at the profits of, Amazon. So you are just short-circuiting the process to achieve scale very rapidly at the cost of current profitability. And that is because in the olden days, bankers or investors would not give you capital if you didn't make profits. Today, there is a set of capital which is available, which is willing to tolerate losses in the early stages of a build out. I think that's the difference. So how you evaluate these businesses requires a little bit of a different mindset, right? And, but right now it's a great fun trade that everybody is on.
Zamana chal raha hai waisa, so why not? I get that. I mean, who knows where the Sensex will look like 10 years from now? If you look at the IPOs and the startups who are lined up for listing. But on that very exciting, very thrilling note, folks, that is a wrap on this episode of Paisa Vaisa. Like I said, my honor to have my guest today, Hiren Ved, co-founder, CEO, director, and CIO, Alchemy Capital Management. Those of you who've not heard of Alchemy, guys, seriously, just Google it and you'll find out a lot of stuff. Hiren, thank you for your time and thank you so much for doing this for all listeners.
Thanks, Anupam, and stay safe. And it was great chatting with you.
Thank you, Hiren. Thank you so much. And here's your CRED privilege tip of the week. Folks, have your calendar sorted financially. Okay, you should know when returns are due, which is once in a year. You should also know when your credit card bill payments are due, which is once in a month. So be very, very careful about the milestones in a year where you have to make payments. It could be your EMI, it could be your rent, it could be your credit card bill, it could be IT return, it could be advance tax, could be anything. But create a financial calendar annually. That's your CRED privilege tip of the week. And thank you, listeners, for listening to this episode. If you're enjoying this show, please do share it with your friends, family, and people that you know. That would be really helpful for us. You can listen to this show and other interesting shows on the IVM Podcast app or ivmpodcast.com. You can also follow us on our social media. We are IVM Podcast on Twitter and Instagram. And if you want to reach out to me, I'm your host, Anupam Gupta, B50 on Twitter and B_50 on Instagram. Thank you so much for listening to Paisa Vaisa, presented by CRED, the most rewarding credit card bill payments app, and powered by Quartr.
No material on the show should be considered as financial advice. The material on the show is for informational purposes only. Please consult a financial advisor before taking any investment decision.
IVM